All right, let's talk about AAR Corp. They just dropped the kind of earnings report that, every investor loves to see. It's a classic beat and raise. So today, we're going to break down these really impressive numbers, dig into the strategy that's making it all happen, and then, of course, give you our call on what we think happens next. So let's start with the big one, the headline number. Adjusted earnings per share came in at $1.18. And look, that's not just a beat, that is a decisive beat. It's over 11% higher than what the street was looking for. Just a fantastic start. And you might be asking, where did that awesome earnings number come from? Well, it was powered by some really impressive sales. Revenue shot up 16% compared to last year, totally crushing expectations there too. When you get that combo of strong sales and even stronger profit growth, that is just the perfect recipe for a killer quarter. Okay, so let's dive into the details here. The big picture? This was just a clean beat and raise. There were no weird one-time items, no asterisks, none of that noise. It was just a straightforward, solid beat on every key metric. And then they raised their guidance, which is exactly what you want to see. Now, this is where the story gets really, really interesting. Take a look at the operating leverage here. You see that sales grew a very healthy 16%, right? But then look at the earnings per share. That grew almost twice as fast, up 31%. So how does that happen? Well, it means their profit margins are getting bigger. For every single dollar of sales they make, more of that cash is dropping straight to the bottom line. So they're not just growing, they're growing smarter and more efficiently. Okay, so the big question is why? What's actually going on inside the engine to produce these kinds of numbers? Well, the growth story here really comes down to two key things. First, absolutely exceptional performance in their core business, and second, some really smart strategic acquisitions. So the main driver, the real engine of this growth, is their part supply business. Get this, it grew an incredible 32% organically. Just let that number sink in for a second. This is not a case of a rising tide lifting all boats. No way. This is AAR actively going out and taking market share from competitors. And what's wild is that this has been their fastest growing part of the business for 4 years straight, and it's actually speeding up. And here's their secret sauce. This is their competitive advantage in action. They have this two-way exclusive distribution model, which basically creates this powerful economic moat around their business. What it does is build these super deep, really sticky relationships with the big suppliers. And the proof is in the pudding, right? They have a 100% contract renewal rate. That one number tells you everything you need to know about how much their partners value what they bring to the table. Okay, now let's talk about the other piece of the puzzle, the M&A. This is where it gets even more strategic. AAR went out and bought HAECO Americas. Now, this was a brilliant move to lock up something that is just incredibly scarce and super valuable right now, and that's space for heavy airframe maintenance here in North America. And what's great is that they have a really clear 3-step plan to turn this acquisition into a total home run. So first up, they're swapping out the old existing revenue for nearly $1 billion in new, higher quality, more profitable contracts. Step 2, they're plugging in their own super efficient operating model to these new facilities. And finally, they're getting rid of a high-cost facility to streamline everything. It's just a crystal clear roadmap to make the entire company more profitable over the next year or so. And this quote from management on the earnings call says it all. We have effectively sold out the acquired capacity for the next several years. I mean, wow, think about that. They've already sold out all this new space for years into the future. That takes a massive amount of risk off the table for this deal and just shows you the absolutely overwhelming demand there is for what they do. All right, so that's what happened this past quarter. But as you know, the market always looks ahead. So now let's talk about the guidance and what management is expecting for the future. And what their guidance shows us is actually an acceleration in growth. For the next quarter, Q3, they're forecasting sales growth between 20 and 22%. That's when that big acquisition really starts kicking in. And for the full year, they're still looking at growth approaching 17%. Let me tell you, for a company of this size, that is a seriously strong number. And this, right here, is the raise part of that beat and raise we talked about. They actually bumped up their forecast for organic sales growth. That means the core business, even without the acquisitions, is doing better than they thought. Now, you will see they're guiding to slightly lower margins next quarter, but don't worry about that. That's totally expected while they're integrating the new business. They were super clear that the long-term path for profits is straight up. Okay, so let's zoom out a bit and put all this into context. How does AR's performance really stack up against the rest of the market? Well, the short answer is they are just executing flawlessly in what is already a very, very strong environment for their business. I mean, this chart really tells the whole story, doesn't it? Over the last year, AER's stock is up more than 46%. That is just blowing away not only the S&P 500, but also its own industry group. Folks, this is what real outperformance, what we call alpha, actually looks like. And you have to understand, AAR has this massive tailwind at its back right now. All the delays in getting new planes from the big manufacturers, that means airlines have to keep their existing planes flying for longer. And every single extra year an older plane is in the air, that creates more and more demand for AAR's bread and butter, maintenance, repair, and overhaul, or MRO. And of course, all the parts needed to do it. Okay, so we've gone through the fantastic quarter, we've talked about the strategy, we've looked at the guidance. Now it's time to put it all together and make our call on what happens from here. So after a report like that, the big question on every investor's mind is pretty simple. What's the trade? What do you do now? I mean, has all the good news already been baked into the stock price? Well, here's our call. First, we think they're going to beat expectations again next quarter. That momentum in the parts business just isn't slowing down. Second, we fully expect the stock to keep outperforming as the market really starts to get its head around the huge profit potential from that HAECO deal. So, our official rating is outperform. This is just a classic case of a great management team executing perfectly on a brilliant strategy. And hey, if you're looking for a more specific idea, here's one we'd call wild but plausible. You could look at some call options that expire after their Q4 report. What's the bet? You're essentially betting that management is being a little conservative with their timeline and that they'll actually deliver those HAECO profit improvements faster than the 12 to 18 months they've guided to. If they do, you could see a really nice guidance raise later this year. Now, of course, as always, please do your own research. This is not financial advice. So I'll just leave you with this one final thought, because I think it's really the key to the whole AAR story right now. By buying HAECO, AAR got control over a really scarce and absolutely essential asset. And in today's market, when you control that kind of scarce capacity, you control the pricing power. And believe me, that is an incredibly powerful position to be in.